Bowie, super coach, great to see you. What an outstanding part of the day this is. Again, the serenity, the tranquility, the peace, the opportunity to clear the fog and be able to tune in ever so finely into that business channel for the day and create a fantastic nexus or segue from that rest and sleep channel. So I just wanted to equip you with some information, or at least my observation, and hopefully some dialogue that will help you in the marketplace about the well-publicised 800,000 mortgage holders that are due to come off their fixed rate this year. So just a few things. Number one is we've got to remember that only 30% of Australia's population hold a mortgage. The other 30% rent and the other 30% are unencumbered, right? So that's number one. So we're dealing with a smaller part of the population, notwithstanding that 800,000 is a big number. However, what we need to remember is our banking system, as I've said before, in Australia is one of the most robust in the world. So what happened is the regulatory authority, APRA, some years ago when the cash rate was practically zero, quite smartly and accurately increased the buffer rate from 2.5% to 3%. So effectively what that meant was, even though a mortgage holder was only due to pay around 2% interest rate, despite the cash rate being, practically zero, the banks are already making money at 2%. However, what they did is they assessed every application and every applicant at actually 5%, because that's that 3% buffer rate, or assessment rate as they call it. So they were actually spot on. Why? Because when they come off those fixed rates, they're going to be at around that 5% mark, right? So these applicants have been stress tested both in terms of serviceability, income, and their own financial position at that rate. So that's point number one. Point number two is a large majority of mortgage holders are investors, and they are very fortunate enough at the moment to be enjoying the increase in rates at the moment in terms of rentals, because they are quite significant. So that will also assist them with those increased mortgage payments, given that they are having a sharp trajectory in the upwards direction of increased rents. The other thing we've got to remember is that a lot of the media that are pushing this message out there, it's mainstream media, or you can call it mainstream propaganda, whatever you want to call it, but they're very agenda based. So you've got to keep that in mind. The other thing is that our banking system, as I've said, is so robust, so strong, that they are also prepared for a very high retention strategy when these fixed rates do come off. So what we need to know is the banks are investing heavily in their retention department. So of course, if your fixed rate comes off and it goes to the higher rate and you don't contact the bank, of course they're going to take the opportunity and charge you 5%. However, it's simply making contact with the bank, and even the Reserve Bank are telling you to do this, and every financial advisor, every accountant will be telling you to do this, that the banks obviously have an advertised standard variable rate. However, there's a lot of room to negotiate there, because the banks have learnt that to actually retain clients is cheaper than trying to gain new clients. So they're going to go really hard, and they're going to double down on retention. They've got entire departments for this. I've spoken to them myself. So we've got to remember that. The other thing is the default rate. The default rate in Australia is extremely low. And this is not the first time interest rates have gone up. I mean, of course, it's been 11, 12 years, I get it. But, I've been doing this 35 years and I've been observing the markets for a long time. And that's why they're called markets, because they fluctuate, whether it's a real estate market, whether it's the cash rate from the Reserve Bank, whether it's interest rates from the bank. So you're talking like less than 0.5% in terms of, default rate. Now, there's going to be a lot of propaganda from the mainstream media about this mortgage cliff. Now, I think it's very cliche. I don't think it's completely accurate. I think there's a lot of astute mortgage holders who are obviously foreseeing their situation, and they're either gaining increased rent or they're planning to potentially take some money off the table and sell one of their investment properties. I know that, I did that last year in terms of reviewing my portfolio. I thought that was a really good idea at the time, and it was a terrific price and a terrific outcome. And then you've also got people that are actually tightening the belts. We know that. Why? Because in February, the inflation numbers had a 6 in front of it. In January, they had a 7 in front of it. And in December, they had an 8 in front of it. Now, their monthly inflation numbers this month in April, we're actually going to receive the quarterly inflation numbers for the period ending March. Now, what you're going to find is the posturing from the Reserve Bank is working. The interest rates are working. Why? Because people are tightening their belt. So home ownership is going to be their priority. Investment properties is going to be a priority. They will make concessions in other areas of their life, and we're already seeing that based on the inflation numbers. So what we've got to remember is when you hear all this stuff about America and default rates, mortgagees, etc., you've got to remember that a lot of those loans are what they call no recourse loans, which basically means if you owe money, you can actually just send the keys back to the bank and walk out of the property, and they won't chase you for it. Not all, but a lot of the loans are structured that way. There's an old saying that it's called jingle mail, because the banks used to receive all these keys in envelopes at the bank. So, that doesn't happen here. So you've got to remember, we're dealing with an astute clientele of mortgage holders who are going to tighten the belt. They're going to plan for this. Now, are we likely to see more stock on the market? Of course, because not everyone's going to be able to make concessions in other areas. Some people will need to de-risk. Some people will need to downsize. Some people will need to sell some investment properties, but they'll do it with foresight. They'll do it with consultation with their financial advisors and accountants, and they'll do it in a timely manner, and there won't be this manic rush and this mortgage cliff that the mainstream media want to propagate towards you. So I hope that helps when you're talking to buyers and sellers. It's good information to know. You want to be adding value. You need to be offering some sort of unique selling proposition and some sort of information every time you're talking to your customer base. So live with virtue, God bless, and see you next time.